So target costing here is basically a concept whereby we talked about actual cost, right? Actual cost. Talk about actual cost of results. Actual cost of the results. Then you compare with the targeted information that the company is having. So once that is done, you'll be able to see you are going to arrive at two things, right? You are going to arrive at two things. So we have number one, cost gap. We have cost gap. Number two, we have what we call cost saving. We have what we call cost saving. So target costing is whereby a company has been able to sit down, or the management of this particular company has been able to sit down and come up with the total cost that they are going to incur to be able to provide a given service or even produce a given product. So in the process of doing that, they are going to capture a lot of costs, right? They are going to capture a lot of cost in terms of the initial investment cost and any other cost incurred during that particular period. And then from that point, they'll be able to get their target or be able to set the target cost. So to the target cost, they are going to compare again now, once the activity is fulfilled or it is done, they look at the actual results against the target activity or the target figures. So when our actual results is more than the target cost, it means the company has spent more than what was budgeted for, and therefore we call that difference cost gap. And then if the company has been able to spend in terms of cost less than what was budgeted for or than what was actually indicated under the target system, then we call it cost saving. They have spent less. They have saved the expenses that was budgeted for, and therefore we call it cost saving. So now I've said, remember, we are not going to handle this topic number 4 concept only. If you look at most of the questions under this particular concept, it has been combined with topic number 5. So you find topic number 5. Topic number 5 will appear there. You'll find again topic number 2. Topic number 2 will also appear there. So I believe we did, I think I taught you at the early stage of this particular semester, I taught you learning curve concept. And we were able to answer some of the questions under the concept of learning curve. So learning curve, basically, we did learning curve and we said cumulative cost for labor hours is equal to A x raised power b, right? Raised power negative b. That's what we did. That's what we did. Should be +1. Good, that's what we did, right? Now, we're able to see when we're dealing with the learning curve effect or concept, it was not brought as independent concept. They brought in the element of target cost. And of course, that in reference to what was tested in, is it April? If you look at April 2023, question number 4, April 2023, question number 4, they brought something specifically covering 90% of the question was referring to learning curve effect. But now when we got to the question, and now the final items we were to handle in that particular question, we were told to do something about target cost, right? Good. Again, in the same concept under target cost, you will find that for you to deal with the target cost and the actual results, the examiner will be bringing in the ratios. Where are we getting these ratios from? Performance measurement. Performance measurement ratios. So that's where we're going to get what we call margin. We'll be getting what we call margin. We'll be getting what we call markup. Margin, we have the item that is given. If you're told about profit margin, gross profit margin, net profit margin, operating profit margin, we know very well it will be dependent on it is expressed as a percentage of total revenue or total sales. When you are told to come up with a markup, then markup is dependent on the total cost. markup is dependent on the total cost. So if you're going to give us net profit markup, it is net profit divided by cost of sales. If it is gross profit markup, it is gross profit divided by cost of sales. So markup is going to give us a denominator or expressed as a percentage of cost of sales. I believe it is also the same class that I added something to do with the interaction between margin and markup. The interaction between margin and markup. So if you are given markup, if you're given markup of A over B, then your margin is equal to A over B plus A. That's what we said. So in some questions, the examiner will be giving you results that will enable you to get margin. But now what is required in the question relates to markup. And therefore, you will be forced to translate your margin back to markup before you get the actual cost of sales or actual cost incurred in that particular company or data set. So that's what we are going to do again in this particular question. We are not going to get a specific question, just going straight to the target costing. It must borrow some of the concepts from either topic number 5, topic number 2, or any other topic that you'll be able to cover at this particular level. So that's what we have there. And just to touch on it, so we've now talked about cost saving. We've talked about cost gap, right? We've talked about margin. We've talked about markup. Now, when we now go specifically to target costing, these are the set standards of the cost set by the company. And of course, they are going to be used to compare against what is actually incurred in a given period. And then from that point, you'll be able to tell whether they have cost saving or cost gap. Then let's come to product life cycle. So product life cycle, this refers to the total cost you are going to incur from research, right? So we have research and development. You want to develop a product, you want to introduce a new product, right? So you're going to bring in the cost you're going to incur from the research. You've just been able to come up with an idea of introducing a new product. So that idea, of course, maybe you'll be coming up with the strategies, and then you share with the experts to be able to give you their input towards the same. The amount you're going to pay them will be regarded as part of the research and development cost. Anything you are going to incur to make this product ready for sale will be recorded. Then remember, once the product is developed, it will be launched into the market. The launching expenses, the variable cost that you're going to incur over time will also be included to be part of the product cost. So the product life cycle costing is basically giving us the total cost incurred from time 0 when the product is being developed, right? From time 0 during the development until you have that product now declined, or it is basically eliminated from the market. So let's say if that product, once it's developed, you're going to incur some cost at this point. You'll be able to sell the quantities, whichever limits you're going to sell, until you get to a point whereby you cannot sell it again. So yeah, maybe we can have something of this thing. You're going to develop the product. You get to a point whereby you are now selling the maximum number of units, and again, then it declines, right? So we have those stages that we'll be having at some point. We have those stages, right? At this point, this is the optimal point. That's the optimal point whereby you are selling the maximum number of units. So if you don't do anything about this particular product at this stage, then of course, it will be eliminated in the market by either introduction of a new product into the market to replace this particular product. So all the costs you're going to incur from this point, to the time the product will not be sold to anyone in the market, is what we call product life cycle costing system. we're going to have two things. Here, it will enable us to get, remember we are covering a topic called pricing decision. You want to set up the price of your product so that you get profit, right? You want to reward yourself. Maybe you want to charge some margin or markup. For you to be able to change that markup, you must be able to identify cost of sales. For you to be able to change that margin, you must be able to give us your total revenue, and then you distribute this cost per product. So number one, you are going to determine total cost. Total cost throughout the life of this particular product. We'll be determining the total cost throughout the life of the product from the time of development to the time it is now fully replaced in the market, right? Remember, you are doing that at time zero. So all these are estimates. We are trying to estimate at this point, I've been carrying this cost. At this point, I need to maybe bring in additional fixed cost, right? So all those costs are being estimated at time zero before even the product is actually developed, before it is even launched into the market. And then once you're able to identify total cost throughout the lifespan of this particular product, you now come in and maybe come up with a markup as a company. Maybe you want a markup of 20%, you want a markup of 25%, or even 30%, right? So that markup will enable you to adjust and get the target revenue, or even total revenue actually. Talk about total revenue throughout the life of this particular product. Once you have total revenue, remember, at this point, you are estimating cost, and at the same time, you are estimating the quantity of this product that will be sold once it is launched into the market. So once it is launched, you'll be able to tell us, you know what, in year one, we'll be able to sell 40,000 units. In year two, we'll be able to sell 50,000 units. In year three, we'll be able to sell even 10,000 units as now decline. So you get the total number of units that will be sold from time zero to this particular point, right? And then you bring now volume or units of output. Stroke units of output. So if I have units of output here, and I have total revenue throughout the life of this particular product, number one, I can now get selling price. I can now get selling price per unit. In some questions, they are going to tell you not just selling price. Remember, we are having total revenue, and then we have total units. Some books it is called average selling price or average profit. I mean average revenue, average selling price or average revenue per unit, the same as selling price per unit. So that's what we want to do here. With all those stories, that's what we want to do here by looking at a question. Then the last thing before you get to the question, you'll be told, maybe you have this particular product. So what are some of the advantages or importance of actually doing the product lifecycle costing system? Instead of waiting for everything to fall into place, what are some of the advantages of doing product lifecycle costing system? So number one, you'll be able to understand all the costs related to this particular product throughout its entire life, right? All the items needed to make this product from the time of development to the time it is eliminated from the market. So by doing that again, you'll be able to identify some of the challenges in the market. You are telling us, you know what, at this point, we'll not be able maybe to sell more quantity than this number of units. So what will happen at that point? Number one, you can come up with strategies of minimizing on the fixed cost. If I'm not going to increase the volume, then I can reduce on the fixed cost, or I can look for other means to minimize on the variable cost per unit so that I am able to maximize on profit. Number two, am I able to come up with any technology at this particular stage, so that instead of this product declining, I can still stay at this point for maybe the next 2 or 3 years as I look for other means to introduce a new product. So those are some of the benefits that you'll be able to generate by conducting product life cycle costing system. You are able to tell what will happen in advance, and of course come up with strategies or remedies to rectify such kind of things if they will affect your profits negatively, if they will affect your revenue negatively, or if it will affect your cost negatively. So that is it. Are we together up to that point? Are we together up to that point? Are we together up to that point? Good. So that's what we are going to do here, and be able to see it. Now, once we get to the calculation, another thing, in exams, the examiner can give you the question in two ways. Number one, you can be given the question and you are given the discounting factor. Remember, I've said all this is done at 0.0. At time 0, we are trying to anticipate what you are going to receive or what you're going to incur in year 10, right? We are trying to anticipate what you're going to incur in year 8, in year 7, right? Now, if all this will be done in 10 years to come, and we're talking about them at this particular point, then we must be realistic. We must be able to get the present value of this cost we are going to incur in year 10. We must get the present value of the cost at this time when they will be received in 10 years, in 10 years' time. So if you are given the discounting factor, ensure that you are able to discount these costs as they fall due or as they are incurred based on the time. Number two, if the examiner has not given you the discounting factor, then please just do it the way it is. Don't be bothered about the discounted amounts. Just with the way it is given. So maybe from the past papers, we'll see 2 or 3 questions whereby one of them is having the discounting factor and the other one is not having the discounting factor. So without taking much time, let's move straight away to that November. We can now move very fast to that November 2018. We can now move very fast to November 2018. November 2018. November 2018. November 2018. Question number 4. November 2018. November 2018. Question number 4B. November 2018, question number 4B. So we are told here, November 2018, question number 4B. So we are told here that AZK Limited, a manufacturing company, is planning to launch a new product model whose life cycle is 3 years. So the product will be sold over 3 years, right? The following estimated data has been provided. So we are talking about details, 1st of January 2018, 31st December 2018, 31st December 2019, 31st December 2020. So we have 3 years, right? Now, those who have done AFM, those who have done FM, or even AFR, you are able to identify that 1st of January 2018 is time 0. 1st of January 2018 is time 0. And at time 0, there is no production. At time 0, there is no production. We only have initial outlay. But now, product life cycle costing does not consider the initial outlay. Remember what we need here. What we need here is to get the total cost, right? So you don't consider initial outlay independently. Our interest here is to look at how much are we going to incur from time 0 to the last day of this particular product. That's what you want to see. All the costs incurred. All the costs incurred. So we have research and development costs. So they incurred 850, 400 at time 0. Then when you get to year 1, and during year 1, they also incurred 200,000, right? Then the next thing we have product or production costs. So production costs are divided into 2. We have fixed and variable costs. We are all aware when you are handling the CVP analysis topic, you are able to identify the variable components. I mean, our variable costs are dealt with and fixed costs. The fixed costs are constant. They do not depend on the quantity of output. Variable cost depends on units of output. And therefore, if we are given variable cost per unit, we must look for volume. We must look for units of output so that we get the total variable cost. So production cost, we have variable cost per unit, and then we have fixed cost. When we get to marketing cost again, we have the variable component and the fixed component. Then distribution cost, we have total fixed cost. We have disposal of special equipment. Then we have the discounting factor, present value factor. And then the last row, we have production in bracket units. So now that we are given units or volume of output, we can actually get the total variable cost under production cost, under marketing cost, right? Under production and marketing costs. The marketing director believes that customers will only pay 120 per unit. But the finance director believes this will not cover all projected costs throughout the product's life cycle. Throughout the product's life cycle. Now, is there someone who can help us identify what 120 shillings per unit represents? Somebody to help us identify that, because once we identify that, then everything will fall into place. Let's see. What does this 120 shillings per unit represent? Actual price. The marketing director believes that customers would only pay 120 per unit. Actual price, no. Remember, I talked about, for us to be able to get the cost gap or cost saving, we take the target cost plus actual results minus actual results, right? Or what is given as per the information. So what we are having here, that 120 is the target. They are targeting 120 shillings per unit as the total cost. They are targeting 120 shillings per unit as the total cost. Now, if you are able to get target, so we now have target cost of shillings 120 per unit. We should be able to get the price or cost per unit under the product life cycle costing system. So the product life cycle costing system, we must get the total cost for the 3 years, then we divide by the number of units. We divide by the number of units. Now, if you look at this question, are we going to discount the the expenses or the cost? Are we going to discount the cost? Are we going to discount the cost? Yes, we will be discounting this cost because we have been given the discounting factor. We have been given the discounting factor. Good. Now, We have two ways of dealing with this question. Either of the two will get you to the same point. This is what you are going to do. I want us to maybe help us here, save on time. So we have January 2018. January 2018. We have December 2018. We have December 2019. And then we have December 2020. We'll start with the first one. We'll start with the first one, that is research and development cost. So we have research and development. So January 2018, the company incurred 850,400. 850,400. The next one we have 200,000. 200,000. Good. Then 2019 we don't have anything. 2020 we don't have anything in regards to research and development. So let's go to production cost. So we have variable production cost. We have variable production cost. So variable production cost, we are told that it is 100 shillings in 2018 December, 80 2019, and 90 2020. So let's get the total variable cost. In January 2018, no units were sold, right? We don't have any unit which was sold. There was no production, and therefore we are, we don't have any unit that was produced. So we are not going to have variable production. How about 2018 December? The variable production cost per unit is 100 shillings. Are we able to identify units of output? How many units were produced? How many units were produced December 2018? 20,000, right? So when you take 20,000 times 100, how much are you getting? 20,000 by 100? 20,000 by 100? 20,000 by 100. 20,000 by 100. What are we getting? Is it 2 million? Good, we are getting 2 million. Then, so that is this year. How about 2019? We'll be taking 80 shillings per unit multiplied by 20,000. 80 by 20. 80 by 20 ni ngapi? 80 by 20. 80 by 20,000. 1,600,000. 1,600,000. 1,600,000. Good. Then 2020. What are you having for 2020? 90 by 20,000. 1,800,000. Good. That is variable production cost. Then we go to fixed production cost. So we have fixed production cost. So the fixed production cost, we don't have any here. 2018 December, we have 500,000 also. So we have 500. We have 500,000. We have 500,000. Good. Then from the production cost, we are going to marketing cost, variable. Marketing cost. So variable marketing cost, variable marketing cost, we have 12 shillings per unit. That is December 2018. So we take 12 by volume of output, which is 20,000. So 12 by 20,000. 12 by 20,000. 240,000, right? So we have 240,000. The next one, we are having 8 by 20,000. 8 by 20,000 in 8 by 20,000, 160,000. 160,000. Then the last one, we have 10 by 20,000, will be 200,000, right? Will be 200,000. That is variable marketing cost. Then we get fixed marketing cost. So we also have fixed marketing cost. The fixed marketing costs, we have 200,000, 150,000. And then we have 100,000. Good. From marketing cost, we are moving to distribution cost. So we have total fixed cost. We have total fixed distribution cost. So we have fixed distribution. We have fixed distribution cost. That is 120,000 all through. Good. From the fixed production cost, I mean distribution cost, we have disposal of special equipment. Disposal of special equipment. So for them to dispose this special equipment, they incurred a total of 300,000. So for example, if you're going to do maybe like extracting mineral from somewhere, right? So once you are able to get all the mineral deposits, you must be able to do what? To level the place where you're actually taking the mineral from, right? You must do after mining, environmental management activities, whereby you're going to be filling out that particular space. So the cost you're going to incur to be able to recover that environment will be part of the cost incurred during the life cycle of that particular product or project. If you are using toxic chemical, and therefore you must be able to dispose this chemical in a place that will not affect those who are using the surrounding environment, then of course the cost incurred again to dispose that particular chemical will be part of the product life cycle cost, will be part of the product life cycle cost. That's why now the disposal of this special equipment has attracted a cost of 300,000 in the last year, 300,000. Any other cost that you're having here? There's none. So once you're able to bring in all the costs, we now have the cost incurred from period 1, 2, 3. Of course, from period 0, actually, from 0, 1, 2, 3. Now, I said we have two methods. We have the discounting factor, right? So let's get total cost. Let's get total cost. So total cost, we're going to do the summation. We'll be doing the summation of all the costs. So can you add everything? In this column, we have 850, 400. This side, we have 200 plus 2 million plus 500 plus 240 plus 200 plus 120. What are we getting? 32,60,000. So we have 32,60,000. Great. How about 2019? How about 2019? 2530. 2530. Great. Then December 2020. December 2020. 3020. So we have 30. Good. So let's come and bring in the discounting factor, present value, interest factor. So present value interest factor is given there as 0.89 and in 1. Remember, this is times 0. If you're doing a FM, would have indicated this as times 0, right? So 1 plus R plus the bracket raised power negative n. So negative 0 will give us 1. Then we have 1, 0, 1, 2, 3. So the examiner did not give us the exact rate, but we are given the discounting factor. So let's have the discounting factor down here, 0.89. Of course, reduced to decimal places, 0.80. Then we have 0.71. So once we are able to get the present value, we can now get, discounting factor, we can get the present value. So total cost, we need to get the present value of the total cost. As at today, are we able to get that? So 1 times 850, 400 will give us 850, 400. As at today. How about this one here? 1 year down the line, 3,260,000. Is disposal of equipment a cost? Yes, I've actually explained here. You are doing mining somewhere, so you have to rehabilitate the mining place. You have to rehabilitate the mining place, right? So that will be, you are going to incur cost to be able to rehabilitate that particular environment. You are using some toxic chemicals, and now that you are done with the extraction of that particular product or mineral, you are not going to store this toxic product. You are going to, you'll be disposing it. In the process of disposing that toxic product, you are going to look for experts who will be charging you for the effective disposal of that particular chemical. So we're talking about disposal of special equipment. They incurred cost to be able to dispose it. So we have 2901. 2901, 400. How about December 2019? 2024. 2024. Then 2020. 2020. 2144, 200. So these are the costs. These are the present value of all the costs incurred throughout the life span of this particular product. Throughout the lifespan of this particular product. Good. So let's now get to this place. Let's get to this place and do what? We can get the total cost. Can you get the summation? When you add all this, what are you getting? When you add everything. Add everything, add everything. Add everything, then you give me the answer. Add everything. Add everything, and then you give me the answer. What are you getting? When you add everything, that is 79.20. So we have 79.20. That's the total cost, right? That is the total cost. Good. Go ahead and give me total production for units. Units produced over the 3 years. Units produced over the years. Units produced over the 3 years. We have 60,000 units, right? We have 60,000. We have 60,000 units. 60,000 units. Good. So having done that, please go ahead and give us the cost per unit. Life cycle cost per unit. Per unit. Life cycle cost per unit tunapata ngapi? Life cycle cost per unit 132, right? We have 132 shillings. How did we get 16,000? Okay. So there's that column where we are given units. Angalia, there's somewhere we have units. We have units somewhere. Production in units. In year 0, no unit was produced. In December 2018, they had 20,000 units. In December 2019, I can see 20,000 units. December 2020, 20,000 units. Are you able to see the figures? Are you able to see it, Maria? Are you able to see the units produced? Good. So that's what we are given. That's what we are given there. Now, remember I said we can solve this using 2 methods at this point. So somebody, instead of getting the cumulative cost at this point, this is what they are going to do. They are going to take, let me just put one somewhere here. They'll be taking, for example, research and development cost. Somebody will be doing this. Somebody will be doing this. Let me just have it here demonstrated. So somebody will be coming and telling us, you know what, in year 1, or actually for the research and development cost, to get the total, they're going to take 850. Yes, they're going to take 850,400 times discounting factor, which is 1, plus 200,000 in year 2 times discounting factor 0.89, right? And that is the total research and development. So research and development cost, we'll be able to get the total. They come to variable production cost. So variable production provides cost. It's cost variable production cost. They will now come and say variable production costs. We have 2 million. They'll be coming and taking 2 million, right? 2 million times, it is in year 1 times 0.89 plus 1,600,000 times year 2, the discounting factor in year 2 is 0.8 plus variable production cost 1,800,000, right? 800,000 times 0.71. So by doing that, they'll be having total research and development costs. We can have the total somewhere here actually. We can have the total here. About total. Are you able to get it? Are you able to get it? When you deal with this one here, what are you getting? That is now method 2. We want to compare if we'll be able to arrive at this 7,920,000. That's what I want us to do. So when you take 850,400 times 1 plus 2 million times 0.89, what are you getting? What are you getting? What are you getting? What are you getting? I want us to compare the two. I want us to compare the two. So we have somebody's getting 2630, somebody's getting 1028, 400. So the first one is 10, 28, 400, right? 10, 28, 400. How about the second one? Variable production cost, the present value. Present value of variable production cost. Present value of the variable production cost in that. Okay, let's start with the, what is the present value of research and development cost? Research and development is this one here, right? Research and development. So let's go to variable production cost. Variable production cost. Tunapata ngapi? Variable production cost tunapata ngapi? 2736. Oh, that's not again, 27. Good. Let's go to the next one. From variable production cost, go to fixed. Fixed production cost. So fixed production cost, we have 500,000 all through, right? 500,000 times 0.89 plus 500,000 times 0.8 plus 500,000 times 0.71. What is the total for the fixed production overheads? The present value, 1,200,000. 1,200,000. Good. Let's go to the next one. The next one, from fixed production cost, we have variable marketing cost. So we have variable marketing cost. The variable marketing cost will be having 240,000. So we have 240,000 times 0.989 plus 160,000 times 0.8 plus 200,000 times which 0.71. So what are we getting? What are we getting? Variable marketing costs, 483,600. 483,600. Good. Then once that is done, we add fixed marketing costs. Fixed marketing cost. We have 200,000. Were we having any figure here under fixed marketing cost? Times zero. Are we having any figure for times zero? Were we having any figure for times zero? No. So let's have the first one is 200,000. 200,000 times 0.89 plus 150,000 times 0.8 plus 100,000 times 0.71. So what are we getting? Fixed marketing costs. 369,000. 369,000. Good. So from the fixed marketing cost, which one are we leaving out? Which one is remaining? Let me look at the titles that were given. Fixed marketing. We have distribution cost, fixed distribution cost. Fixed distribution cost. The fixed distribution cost, we have 120,000 all through. 120,000 times 0.89 plus 120,000 plus 0.8 plus 120,000 0.71. What are we getting? Fixed 288,000. Thank you. 288,000. Great. Then from the fixed distribution cost, we have disposal of special equipment. So we have disposal of equipment cost. It was incurred in year 3. It was incurred in year 3. How much? 300,000. So we take 300,000, multiply by the discounting factor in year 3, which is 0.71. So what are we getting? 0.71 by 300,000, 213,000. We have 213,000. Good. So can you get the total? Can you get the total cost? Total cost, present value of the total cost. Add everything in this column. Add everything in that column. Add everything in that column. And everything in that column. Everything should be added in that column. Everything should be added. Everything should be added. Unless there's one that was left out. 63.18, somebody's getting 77.920. Remember, this is part of the figures. 1028, and of course 230, 288, 369, 483. This is 1 million. This is 2 million. This is 1 million. 63.18. How are you getting the figures? When you add everything in this column, are we getting the same thing? This one is not involved. Added everything. So which one should we go with? If it's 79.20, I'm a 63.18. Are we having all the items? Let's see if we've captured everything. So we have research here. So production, we have fixed and variable. Marketing, we have fixed and variable. Distribution, we only have fixed. And then we have disposal of the special equipment. So everything is captured here. Everything is captured here. This is forgetting 63.18. We should be able to get the same thing. The only difference is the other one we are doing it vertically, but this one here we are doing it horizontally. Unless something was left out. Let's see. Variable production cost should be 43.38. Variable production cost should be 43.38. 43. So can you redo this one here? Someone gave us a wrong figure. Can you redo this? This is 2 million. This is 1,600,000. This is 1,800,000. Can someone redo it, please? Is it really 2736 or is something else? I think that's what the problem is. When you do away with this, can you give me the right figure for variable production cost? Variable production cost, 43,38,000. 43. Good. So when you now include this, are you getting the same thing as this one here? Are you now getting 7920? So it is 79. 7920. 7920. Good. So that is what you are supposed to. So whichever method you're going to apply, please ensure you are arriving at the same. Now, of course, if you look at maybe the revision kits that you have, you'll find maybe they have used this particular method. They have used this particular method. But now I want to give you an advantage. Why? Using the other one, the table, will give you more benefits. Now, you are doing your workings. You are not able to effectively apply the discounting factor. You are not able to effectively apply the discounting factor. So if you do your workings without discounting the cash flows, the expenses, without discounting the expenses, we are going to mark all the expenses. We'll be giving you marks for all the expenses. So once we get to the point whereby the discounting factor is required, we now eliminate and stop at that point. But if you are using this method and something is wrong, I will not come into this and say, you know what, this is correct. So I will be marking this. I mark it and say this one is wrong. No. So long as one item is wrong here, we give you an X and then you proceed to X. So I would advise you go with this method 1. But of course, if you are okay with method 2, there's no problem. So long as you're able to get the answer, it should still be okay. Good. So if we are getting 7920,000, it means we will still end up getting life cycle cost per unit is 132, will be 130. So I want us now to make some calculation here. So we have life cycle costs. We have life cycle cost. Target cost is 120, then life cycle cost equal to 130, 132 shillings per unit. Can you now advise these people? If they were to set selling price, are they going to set anything below 132? If they were to set selling price, are they going to set anything below 132? No, because if you set anything below 132, you'll be making losses. If you set anything equivalent to 132, you will not make any loss, you will not make any profit. So the life cycle costing system here has now enabled us to know the total cost per unit, the estimated cost per unit. So from this point, if you decide, the company will say, okay, cost per unit is 132. They normally have a markup. Let's say they have a markup. They have a markup of, we're talking about 10%. Remember, markup is based or is dependent on cost. So if markup is 10%, it means we have cost per unit 132. Then markup is 10% of 132, giving us 13.2. So 1.32. 10% of that is 1.32. So what are we getting? What are we getting? Markup. Markup is equal to profit, let's say profit over cost to sales. Now that we have cost, do we have markup? Yes, 10% is the same as 1 over 10, right? 10% is the same as 0.1 or 1 over 10 is equal to profit. Do we have that profit? Do we have that profit? No. Do we have cost? Yes, we have 132. Should be 13.2. 132. Good. So once we have that, and we now make profit the subject of the formula. The profit is equal to 132 divided by 10, giving us 13.2. What if you are required to give us now a markup? Margin. We said that margin, if margin is given and then we have markup. So markup is equal to A over B. Margin will be A over B plus A. Do we have that in place? Yes, we have it here. So our markup, if our markup is 1 over 10, then our margin will be the numerator, right? 1 over denominator, which is 10, plus the numerator figure. So it means our margin will be 1 over 11. 1 over 11. Good. So if you have margin of 1 over 11, are we able to get profit? Because margin now is equal to profit over sales. Profit over sales. So what do we have in place? We have profit. By use of markup, we've been able to get profit of 13.2. So margin, that is 1 over 11 is equal to profit 13.2 over sales. So can we now get sales? Make sales the subject of the formula. 11 times 13.2. So what are we getting as the sales? What are we getting as the sales? What are we getting as the sales? Sales in that. 145.2. 145.2. Alternatively, you have total cost here, right? You have total cost here. You have total cost. So when you take cost 132 plus profit markup, which is 13.2. Number 5, 145. As simple as such. So you can go this direction or just take this out. Okay, so when I add these two, cost plus profit markup, you're going to be able to call selling price. If it's by using that, the selling price is 145.2. If I cannot get it that way, I follow the margin procedure to be able to arrive at the same answer. Good. So can we now identify cost gap or cost saving? Which one do we have in place? We said we take target cost minus the unstated, or they targeted to have 120 shillings per unit as the cost. They ended up arriving at 132 shillings per unit as the cost. So do we have cost gap or cost saving? Do we have cost gap or cost saving? We have a cost gap, right? So how much is the cost gap? How much is the cost gap? I take 132 minus 1. Give us, is it 12? It is 12. It is 12. It is 12. Good. So that is what you are required to do there. The last part of it, the last part of it. So evaluate the life cycle cost per unit. We've already done that. We did it down here, that 132. Then Roman 2, comment on the target price by the marketing director and suggest ways of reducing any cost gap. Comment on the target price by the marketing director and suggest ways of reducing any cost gap. Good. So we have been able to see we have a cost gap. We are likely to spend more than what they targeted here. So what are some of the things that are going to put in place to be able to minimize this on this life cycle cost, this 132? What can we do? Reduce this 132 all the way to at least equivalent to 120 or even below 120 for them to make some good profit. So what are we going to put in place? We have looked at this product from time 0 to the last day of the product within the market. So what have you been able to see in terms of the cost elements that we are having there? In terms of the cost elements, bulk buying, remember, so we cannot really increase volume because for the entire lifespan of this particular product, they are only going to sell 60,000. That's what they can sell. So maybe volume is fixed. As for this, the volume is fixed. Units of output cannot be changed. Unit of output cannot be changed. Can you look at the first item? We have research and development cost. What if this research is done manually? Are they able to automate and maybe incur at least half of 850, 200,000? To incur at least half of 850, 400. Instead of incurring 850, 400, they can automate it and spend around 500,000, and then they forget about the difference and also what would be incurred in December 2018, right? Good. Number 2, another thing that they can do, remember variable production cost. Variable production cost, as what it is for your information, people are not going to be perfect because this product will be introduced at time 0. So we expect something to do with what we call learning effect. So this company must try as much as possible to come up with ways of motivating the employees. Because once these employees are motivated, we are going to have reduction in variable cost as we proceed. Why? These people will be motivated, they'll get used to this work, and then they are going to take less time to do the same production over time. But if the company fails to do that, they might end up incurring more than what was targeted, right? Why? Because after every maybe 6 months, they have to bring some new person to replace those who have left the company. So people are leaving the company due to poor working condition. So in that effect, we'll keep on bringing in new people who have to learn over time before they get used to the production system. So if that happens, you are going to incur a lot of cost, that is the variable production cost, to generate this particular product. So they have to look for some incentives to motivate the employees. By doing that, they are going to increase the effectiveness of their employees and therefore reducing the production or variable production cost. Total fixed cost. Total fixed cost, what can they do? Again, total fixed cost, maybe they have rented a space. This space is not fully utilized. So what do they need to do? They can bring in another product or another service within that particular space to be able to do what? To be able to recover, to share the fixed cost with this new product and the other service or product. By doing that, they'll be able to minimize on the fixed production cost per unit of this new product. Outsource some functions like distribution. Yes, instead of buying maybe a motor vehicle or a tractor that will be a lorry that will be used to transport their products or distribute their products, this lorry requires insurance, right? You need to do repairs, right? You need to do maintenance of this particular motor vehicle, lorry. You need to buy spare parts. Then you need to employ a driver who will be able to do what? Who will be able to take care of this lorry throughout this particular lifespan of the product. All those costs, purchase of fuel. So instead of having all those costs in place, then outsource. There are those people who have enough resources and actually well versed in terms of distribution or transportation of goods. So you can just outsource that, tell them to hire, and only pay them when you need them. Remember here, even if you have a machine breakdown for even 2 or 3 months, still you'll have to pay the driver. You must take the comprehensive insurance cover for the entire year, right? So such kind of expenses can be minimized by outsourcing some services. Another point to review then, the supply chain. Yes, there are some stages that are actually not necessary. There are some costs you are incurring here that are not necessary. So we can eliminate them and then be able to minimize costs. So those are some of the things you are required to deal with in this particular question. Those are some of the things that you are required to deal with that particular question. So are we now conversant with the target costing, product life cycle costing? Are we now conversant with the product life cycle costing? Are we now conversant with the product life cycle costing? Great. So you can now look at now that you've done learning curve concept. Of course, I personally told you that. Because we've done learning curve concept, there's a question from April City. You can click time and look at it. If I look at it, it is partially learning curve, and the last part of it, you are having some target cost. You are having some target cost. If you look at, is it August 2023 also? We have a question. August 2023. April has got one, if I'm not wrong. August 2023, all of them are 2023 students. You'll be able to see a question whereby you have learning curve as a concept, but now the last part of it, you're given target cost. That target cost or target revenue will enable you to come up with either margin, the one that will be there, either margin or markup. So with that, you can actually translate back to costs. You can actually get back to cost and compare the target and what you are getting when you use the learning curve concept. Are you having a cost gap or cost saving? Right? Yeah, so that is it. That is it. So I believe that is enough for today. That's enough for today. We just want to now end our session. But of course, you've done a lot of things. If you look at, I think you did this as you prepare for your exams. Topic number 7. Topic number 7. In April sitting 2024, they tested something about variances, right? They tested something about variances. So they normally alternate those two concepts. If you look at December 2023, December 2023, we are now talking about topic 7. Topic 7. That is budgeting. December 2023, they tested something about, it is called activity-based budgeting. Of course, at intermediate level, you are calling it activity-based costing. That is December 2023, right? Now, if you come to April 2024, from the same topic, they brought something about variances. And at this level, just be conversant with the reconciliation. You must reconcile. Reconciliation of variances. You have budgeted income statement. You have actual income statement. So with the budgeted income statement and actual income statement, something happened here. There are things that did not go as was planned, right? You plan to sell 10,000 units. You ended up selling 11,000 units. You plan to sell 6,000 units. You ended up selling 5,000 units, right? That is the volume. Again, the selling price. So all those things, when brought together, they will lead to the difference between the budgeted income statement and actual income statement. So you are required to reconcile. Now, this is what normally happens. Don't take like 2 hours trying to get this account reconciling. No. The reconciling figure will not be marked actually. For your information, you will not get any marks for the reconciling amount here. No, you will not get. Because they are going to tell you, give us budgeted income statement if they have actually in place. So budgeted income statement, you give us budgeted sales, budgeted variable cost, budgeted fixed cost, then you get net profit. You cannot get marks for net profit. No, that is not there. You only get marks for sales, variable cost, fixed cost. So once that is done, you come to the reconciliation. How do we reconcile? Calculate the variances. We know very well that anything touching on revenue, for us to get revenue, we must talk about units sold. We must talk about units sold, right? You must talk about selling price. You must talk about selling price. These two, if you use the formula that we are using in class, you'll be getting a negative. And then you are telling us, with that negative, it is favorable. Why? You planned to sell 7,000. You ended up selling 9,000. So if you're going to look at volume, right, it is 7,000 minus 9,000. That's what we are looking for. Sales, margin, volume, variance, right? It is changes in quantity that was sold. So 7 minus 9, you are getting negative 2,000. You know, very negative 2,000 will be favorable because you sold more than what you budgeted for. Selling price, you plan to sell your goods at 700 or even 400. You ended up selling them at 500. Yes, this minus this will give us negative 100, but you received more. This is the actual revenue per unit. So when dealing with the reconciliation, just be sure that selling price variance, sales margin, volume variance, and fixed production overhead, fixed production overhead, volume variance, right? These three, when you get a negative, you call them favorable. When you get a positive, you call them adverse. These are the only three unique variances. That when you get a negative, you call them favorable. When you get a positive, they are now adverse. That is it. So this concept of variances was tested in April. We are now expecting activity-based budgeting or activity-based costing as per intermediate level concept. So just look for a simple question, go through it. I think one is there in, is it April or December 2022? And then of course the last sitting, that is December 2023, there's a comprehensive question there. It was lifted from, is it 2010 or 2008, somewhere there. Nothing was changed, only sitting. Balance scorecard is there in topic number 5. That is performance measurement. So performance measurement, you must tell us, you must know how to get residual income, return on investment, accounting rate of return, right? You must tell us how to get economic value added, right? So these two are tested in last sitting, that is April. We expect them, if they have to set a question from this topic, we expect them to bring this. And of course, if it is a theory, just no balance scorecard is a compulsory thing. Yes, you are taught that by Dr. Ura. Activity-based budgeting. Activity-based budgeting. You are telling us we have support or setup. You're having setup costs, right? Maybe 700. Then you have department A, department B, department C. The cost drivers were here. So we have a number of maybe machine runs or setups. We have 4, 7, 2. When you add this, you are getting 13. So for A, it is 4 over 13 times the cost to be shared. You did that. You did that, you did that, you did that. So those are some of the things that you should be revising at this point. If you go to what we did again under inventory, we are talking about optimal stock level. And then you give us also probability of running out of stock. It was not tested completely, in April 2024. In December 2023, they tested this concept, right? Now we are expecting them to bring, the simulation. It has taken so much time, simulation here. And then once you're able to do the simulation, you give us the average cost per unit over the 10 weeks, over the 10 days, over the 8 weeks, right? Something of that kind. You must prepare for that. Again, learning curve, you don't have a choice. You must just understand it again. Learning curve, you must understand it. And then another thing that if it misses in that paper, then it means you are doing the wrong paper, is what we call transfer pricing. Transfer pricing, whereby you are given division A, division B. So division A is making product K, right? This product K is the raw material for division B. Is the raw material for division B. So division B do not have any choice of purchasing raw material. Of course, they have choice of purchasing raw material from anyone, either internally or outside. But now, division A is being told they have two options. Either to sell, they have two options: selling first everything to B before selling the deficit to the external market. Now, external market is offering a good price, is having a good offer than division B. So where will they sell it to? External market or just internally here before they look at that? If they do it internally and the external market is offering a good price, then it means they're going to lose some money. That money is called opportunity. So we're talking about opportunity costing, right? Transfer price using opportunity cost, the value of the foregone alternative. They are accepting to sell their goods to B at 10 shillings, yet the external market is accepting to purchase the same product at 15 shillings. They are losing 15. That is opportunity cost. So are we able to use that to come up with the transfer price? Transfer price. If your exam will not have this question, then something is wrong somewhere. So this one here, whether it appears, whether it's tested or not, it must appear consecutively. Look at what was there in August 2023. Look at December 2023. Look at April 2023. It has been there. So we have, is it three methods? Yes. We have market costing method. We have negotiated costing method. Then we call it variable marginal costing, right? Or opportunity cost method, right? The limiting factor concept, again, I think it was not tested in April. So limiting factor will be coming under CVP analysis. Either you do CVP analysis for multiple products, individual products, which again was tested in December. So they not test limiting factor. What if it appeared in exams, but now combined with the transfer pricing concept? So we have a lot of things to do. And of course, you've done them in class. So you're actually more than prepared for these particular exams. Thanks for your time. Have a blessed night, and let's meet some